Hello students, welcome to the lecture on International Financial Environment. And after this lecture, we will be able to learn the following objectives. Explain the foreign investment, understand the exchange rate determination, explain the forecasting, discuss the exchange rate regimes, describe the international capital market. Let's start with the concept of international financial environment. As we know that international business activity has been in existence for hundreds of years, more than 200 years back. Adam Smith wrote in his famous book Wealth of Nations that if a foreign country can supply us with the commodity cheaper than we ourselves can make it, better buy it of them with some part of the produce of own in which we have some advantage. The period after the World War II has seen a phenomenal growth in exchange of goods between nations. There has been a systematic effort to facilitate the free flow of goods and services across national boundaries. Rapid economic growth in the Western countries owed much to the relatively free flow of goods and services. Now other countries have joined in this process and growth of international trade continues unabated. Pros and cons of this development are debated and different. Even disputes arise between nations. To resolve disputes and make further progress on free flow, the bodies like World Trade Organization (WTO) have come into existence. Let's discuss the foreign investment. Foreign investment is the movement or accumulation of long-term capital across political boundaries. It may take the form of cash, securities, plant, equipment and other factors of production such as managerial skills, technology or know-how. The growth in multinational organizations which has resulted from foreign direct investment has contributed to the fact that by the turn of the 21st century, over a quarter of the global GDP was produced by just 200 companies. Categories of international capital flows appearing in the balance of payments accounts: short-term investments, portfolio investments, direct investments. These categories are distinguished from each other in the balance of payments accounts, represent different degrees of liquidity and respond to different influences. Short-term investments begins with a discussion of the criterion for making short-term covered investments when there are costs of transacting in the foreign exchange markets. Since short-term investments are important aspects of cash management, looks at short-term borrowing decisions and a number of other aspects of the management of working capital in a multinational context. Portfolio investment considers international aspect of stock and bond investment decisions, paying particularly close attention to the benefits of international portfolio diversification. It is shown that international diversification offers significant advantages over domestic diversifications, despite certain uncertainty about exchange rates. It is included on the International Capital Asset Pricing Model. This model is used to compare the implications of internationally segmented versus integrated capital markets. Definitions of foreign direct investments (FDI). According to the IMF and OECD definitions, direct investments reflects the aim of obtaining a lasting interest by a resident entity of one economy, direct investor, in an enterprise that is resident in another economy, the direct investment enterprise. The lasting interest implies the existence of a long-term relationship between the direct investor and the direct investment enterprise and a significant degree of influence on the management of the latter. Direct investment involves both the initial transaction, establishing the relationship between the investor and the enterprise, and all subsequent capital transactions between them and among affiliated enterprises, both incorporated and unincorporated. It should be noted that capital transactions which do not give rise to any settlement, example an interchange of shares among affiliated companies, must also be recorded in the balance of payments and in the Index of Industrial Production (IIP). Now moving on to the next topic, we will study the exchange rate determination. Exchange rates are prices that are determined by supply and demand. For some countries, the exchange rate is the single most important price in the economy because it determines the international balance of payments. There is no general theory of exchange rate determination, but divide the potential exchange rate determinants into 5 areas: parity conditions, infrastructure, speculation, cross-border foreign direct investment and portfolio investment, and political risks. Although no model has been consistent in predicting short-term foreign exchange rate behavior, there are several major concepts that play a role in determining the long-term behavior of foreign exchange rates. The first concept is based on the idea that the current price of an asset reflects all available information and therefore only unexpected events cause exchange rates to fluctuate points, and that the character and the context of the change will greatly affect the nature of the change. In the short term, exchange rates seem to be affected by news about fundamental economic events, although economic models still remain unreliable for short term forecasting. In the last 25 years, economists have adopted the asset approach to exchange rates in an attempt to explain exchange rate movements. The asset approach emphasizes the role of expectations. In the monetary approach, the exchange rate establishes a relative price between two currencies. In the portfolio balance approach, exchange rates reflect the relative risk and return of two currencies.
To understand exchange rates, you really need to grasp one concept. Foreign exchange, i.e. foreign money, is really just another commodity to be bought and sold. This is where the term foreign exchange market comes from. It's a market, so there must be those who want to buy the currency and those who supply it. On the demand side, what reason or reasons could people possibly have to want to purchase foreign exchange? Well, there are 3 major reasons, really. First, people want foreign money for travel and tourism. Second, foreign money is needed for trade to buy foreign goods and services. Third, foreign money is needed for investment purposes, be it financial investment like purchase of foreign denominated financial assets, or real investment like building a new factory overseas. A change in any of these 3 components will alter the demand for foreign exchange. For example, a lot of recent Hollywood blockbuster movies have been filmed in New Zealand. What if this creates a sudden surge in tourists going to New Zealand? These tourists will need New Zealand dollars, creating an increase in demand for that currency. Similarly, if U.S. companies decide they'd like to build factories in New Zealand, real investment, or purchase New Zealand dollar denominated financial assets, financial investment, the demand for the New Zealand dollar would increase. Now, let's go back to the idea of the foreign exchange market, with the New Zealand dollar being the foreign exchange. Initially, there's a certain supply of New Zealand dollars and a certain demand. The equilibrium price in this market is called the exchange rate. Okay, now let's throw the increase in demand for the New Zealand dollar into the picture. What happens to the value of the New Zealand dollar as more tourists travel there or as more U.S. companies invest? As with any commodity, when the demand for the New Zealand dollar increases, its value increases. We see the exchange rate in terms of the U.S. dollar per New Zealand dollar increase. This is called an appreciation of the New Zealand dollar. When dealing with bilateral exchange rates like this one, that is to say the relative value of 2 currencies, it is necessarily the case that as one currency becomes stronger or more valuable relative to the other, in this case the New Zealand dollar is increasing in value relative to the US dollar, the other currency is decreasing in value or depreciating. In this example, as the New Zealand dollar appreciates, the US dollar is getting relatively weaker or depreciating. Okay, so changes in demand for currency will affect the exchange rate. What about changes in supply? Well, ultimately, who is it that controls the supply of foreign currency? It's the foreign government. If the U.S. wanted to drive the value of its own currency up, it would decrease the supply of dollars. If it wanted to drive the value down, it would increase the supply of dollars. Why would a country want to manipulate its own currency value? Let me give you an example. Suppose you're a U.S. furniture producer and government protection for the spotted owl means you can't get the lumber that you need domestically. So you call up a Canadian lumber mill, tell them you'd like to place an order, and they tell you that the lumber is going to cost 50,000 Canadian dollars. I don't know about you, but my bank account doesn't happen to have any Canadian dollars in it. This is where the exchange rate comes in. If I can figure out how much 1 Canadian dollar costs, then I can use that to calculate how much 50,000 Canadian dollars will cost. The price of 1 Canadian dollar in terms of US dollars is the exchange rate, dollars per Canadian dollar. I checked the dollar per Canadian dollar exchange rate for April 7, 2010 on xrates.com and found that Canadian dollar was equivalent to 0.998 US dollars. Just as a side note, this nearly one-to-one parity between the two countries' currencies is highly unusual. More on that in a minute. So if 1 Canadian dollar costs 99.8 cents US currency, how much will 50,000 Canadian dollars cost? In the end, it would cost you $49,900 US dollars to purchase the Canadian lumber. Now let's take a little trip back in time and figure out how much that same 50,000 Canadian dollars worth of lumber would have cost in April of each year for the previous 20 years. When would you most like to have purchased that lumber? You can see by looking at the data that when the foreign currency is the cheapest, in this case 2001 at 64 cents per Canadian dollar, the foreign imports are the cheapest, 32,000 US dollars. Even if the Canadian lumber mill sees the same 50,000 Canadian dollars every year, the price to the US importer changes as the exchange rate changes. When the Canadian dollar depreciates, the lumber is cheaper and US importers will buy more lumber.
Parity conditions. Parity conditions are an explanation for the long-run value of exchange rates. These include relative inflation rates, purchasing power parity, the relative interest rates, forward exchange rates, and the exchange rates regimes and official monetary reserves. Interest rate parity. Interest rate parity connects the forward rate to the spot rate and interest rates in the domestic economy to those abroad. This relationship holds because the forward rate is known. Additionally, the forward rate is not affected by investors' risk aversion or uncertainty. The international Fisher effect. The Fisher effect describes the long-run relationship between inflation and interest rates. This theory states that nominal interest rates in each country are equal to the required real estate of return plus compensation for expected inflation. Where I is the nominal rate of interest, R is the real rate of interest, and pi is the expected rate of inflation over the period the funds are to be lent. An approximation of the Fisher effect drops the final term. Unbiased expectations hypothesis. The unbiased expectations hypothesis is the theory that forward exchange rates are unbiased predictors of future spot rates. Balance of payments and the asset market. There are two models to calculate exchange rates, the balance of payments approach and the asset approach. In the balance of payments or BOP approach, the domestic price of a foreign currency is determined by the intersection of the market demand and the supply curves for that foreign currency. The asset approach is based on the idea that exchange rates are based on relative real interest rates and expectations for economic growth and profitability. Balance of payments flow approach. According to Solnick, the balance of payments approach was the first approach for economic modeling of the exchange rate. The balance of payments approach tracks all of the financial flows across a country's borders during a given period. All financial transactions are treated as a credit and the final balance must be zero. The types of international transactions include the international trade, the payment for service, the income received, the foreign direct investment, the portfolio investments, short and long-term capital flows, and the sale of currency reserves by the central bank. The current account includes the trade balance, balance of services, net income received, and unrequired transfers. A current account deficit or surplus tends to be correlated with the depreciation or the appreciation of the exchange rate. The capital account includes direct investment, portfolio investment, other capital flows, net errors and omissions. A capital account surplus or deficit is correlated to the amount foreigners are willing to lend or borrow. The third part of the equation, the official reserve account, includes the net changes in the government's international reserves. The BOP approach is also not as accurate for short-term predictions. Asset approach or stock approach. The asset approach is based on the ideas that markets are efficient and that exchange rates are assets traded in an efficient market. The asset approach predicts that the spot rate behaves like any other asset. The value of the spot rate changes whenever relevant information is released. Therefore, prices are determined based on expectations about the future. This approach focuses on the relationship between the capital account and the exchange rates. Let's know the meaning of forecasting. Exchange rate forecasting plays a fundamental role in many aspects of international finance, such as the evaluation of foreign borrowing or investment opportunities, forecasts of future spot exchange rates, short-term hedging, operating and strategic decisions, and competitive analysis. Exchange rate forecasting involves the study of relative political, social and economic conditions of relevant countries. There are two basic approaches to forecasting them: exchanging rates, economic analysis and technical analysis. While there is a considerable disagreement on both the accuracy and the appropriateness of forecasting, it remains a fundamental aspect of international finance. Leverage points out the difference between accurate and useful forecast. Accurate forecasts have small error terms. Useful forecasts help make decisions that lead to profitable speculative positions and correct hedging decisions. Challenges. Due to the competitive and dynamic nature of the currency market, both consumers and producers of exchange rate forecasts face special problems. For example, choosing a method has implications on the forecast. Additionally, there are numerous providers of analysis, and subsequent decisions on how and where to implement analysis will have large implications on the outcome of the analysis. The forecast horizon is also important in any analysis. Forecast horizons can range from minutes to decades. Success depends upon the economic relationships that will persist in the future, and structural changes in the international economy will continue to represent one of the biggest challenges to forecaster. Efficient market hypothesis. Market efficiency represents a joint hypothesis regarding the equilibrium of prices or returns in the market and the ability of markets to set actual prices. When markets are efficient, then market participants cannot earn abnormal returns. The efficient market hypothesis states that a market cannot be outperformed because all available information is already built into all stock prices. In other words, no arbitrage opportunities should exist in an efficient market. Empirical evidence supports market efficiency when transaction costs and other factors are taken into account. This has been restated in terms of 3 degrees of efficiency. The weak form of efficiency states that the current prices reflect all historic information. The semi-strong form of efficiency states that current prices reflect all publicly available information. Policy implications. When policymakers set interest rates, they can be influenced by the expectations for future interest rates. Public policymakers are interested in the efficiency of foreign exchange markets because efficiency markets means that the level of exchange rates and volatility is, on average, a fair reflection of the underlying economic fundamentals. Therefore, in an efficient market, the level and the volatility of exchange rates are due to fundamental factors rather than the misreading of these factors by private investors. Sources of market inefficiencies are uncertain. They can reflect speculation, insider trading, corruption, or poor decisions from central banks and governments. But what is certain is that they create challenges for decision makers. Employment implications. Forecasts of exchange rates are not straightforward. Many professional economists earn their livings based on the belief that exchange rates evolve with detectable trends. Grossman makes this point: markets cannot be perfectly efficient when information is costly, otherwise there would be no incentive to devote significant resources to collect information. Grossman adds that for reasons unrelated to future expected payoffs, prices move by noise created by uninformed investors, allowing informed investors to earn a return for their data gathering efforts. The currency puzzles. There are several puzzles in exchange rate forecasting. The list of some of the common currency puzzles. The first is the forward premium puzzle, which states that the regression analysis between the realized exchange rate movement and the forward premium or the discount reveals that the slope coefficient is significantly smaller than 1 and sometimes negative. This finding implies that a successful trading strategy would be to bet against the forward exchange rate. In other words, expected exchange rates vary over time in a somewhat predictable manner as a function of the interest rate differential. A second common puzzle is that the exchange rates follow trends. ITMER, the intermediate term model-based equilibrium exchange rate model, ITMEER, was created as a modified uncovered interest rate parity model. The ITMER model suggests that the exchange rates move to reflect interest rate differentials and an additional risk premium. The risk premium introduced in the model is influenced by fundamental variables such as the current account, unemployment rates, net foreign assets, relative prices, and yield differentials on financial assets. RGARC models. The RGARC models have become standard tools for questions about volatility. The assumption of homoscedasticity, that the squared expected values of all error terms at any given point are equal, is the focus of RGARC models. Exchange rate regimes. In general, a fixed exchange rate is preferred if monetary changes affect the general level of prices. Examples of fixed exchange rate regimes are pegged exchange rates and crawling pegs. A pegged exchange rate is where the country sets the value of its national currency according to the value of a foreign currency, like the US dollar or the French franc, or a basket of currencies. Central banks intervene to keep the rate between narrow bands through international reserves. A pegged exchange rate may help establish the credibility of a program to reduce inflation. As the expectations of inflation are reduced through the knowledge that government policy must be subordinated to the needs of maintaining the peg, the threat of chronic inflation is reduced. For example, the government cannot increase borrowing while trying to maintain a pegged currency. With crawling pegs, the country sets its exchange rate according to a criterion such as the relative change in inflation. Countries with higher inflation rates than their trading partners often depreciate their currencies to prevent loss of competitiveness. A pegged exchange rate is not sustainable in the long run. A floating exchange rate system is where the exchange rate is free to adjust to respond to changes in relative macroeconomic systems. Floating exchange rates reflect the speculative dynamics of the market. Economic shocks such as a steep rise in international interest rates, a slowdown of growth in the industrial world, and the debt crisis often require currency depreciations and the adoption of more flexible exchange rate regimes. The increased capital mobility and waves of capital inflows and outflows have heightened the potential for shocks and the pressure for flexibility. In general, a floating exchange rate is preferred if real changes such as technology changes or shifts in consumer preferences affect the relative prices of domestic goods. Examples of floating exchange rate regimes are managed floating or independently floating. Currency crisis. According to Solnick, most currency crises have the following pattern. First, the currency runs a growing current account deficit. Thus, the currency is regarded as overvalued by PPP standards. In instances where foreigners were investing in a booming economy and lending to local firms at attractive interest rates, this capital account surplus is covered up by the current account deficit. However, once prospects for economic growth weaken and uncertainty builds, these foreign investors begin to exit the market. As investors exit, the current account deficit is revealed and governments are forced to raise interest rates to attract capital. Contagion. Contagion is a significant increase in cross-market linkages after a shock to an individual country or a group of countries. There are two main channels of contagion: through trade links and through the financial system. Forbes and Rigoborn go on to specify that shift contagion refers to a significant increase in cross-market linkages after a shock, such as the correlation in asset returns, the probability of a speculative attack, or the transmission of shocks of volatility. The theoretical literature on contagion can be divided into two groups: crisis contingent and non-crisis contingent theories. International capital market. International capital market is that financial market or the world financial center where shares, bonds, debentures, currencies, hedge funds, mutual funds, and other long-term securities are purchased and sold. International capital market is the group of different countries' capital market. They associate with each other with internet. They provide the place to international companies and investors to deal in shares and bonds of different countries. After invention of computer, internet, and revolution of financial market in 2010, almost all financial markets are converted into international capital markets. We can give the example of Hong Kong, Singapore, and New York World Trade Center. International capital market was started with dealings of foreign exchange. After globalization of financial sector, companies have to take certificate for dealing in international market. Now, in the end, let us summarize what we have learned in this lecture. Forecasting is used by companies to determine how to allocate their budgets for an upcoming period of time. A situation in which a faltering economy in one country causes otherwise healthy economies in other countries to have problems. A situation in which the value of a currency becomes unstable, making it difficult for the currency to be used as a reliable medium of exchange. The effect of a currency crisis can be mitigated by sufficient foreign reserves. The exchange rate is used when simply converting one currency to another, such as for the purposes of travel to another country or for engaging in speculation or trading in the foreign exchange market. Foreign investment is the movement or accumulation of long-term capital across political boundaries.